Some crazy stuff going on in the housing market to start 2026. Trump just made it official. The Wall Street investor ban is happening. He just signed an executive order from the White House saying that they're going to pursue this investor ban. I'll give you the details on that later in this video. But first, I want to talk about some concerning data from the National Association of Realtors. They announced that in December 2025, pending home sales dropped 9.3%, a complete collapse in contract signings on houses at the end of 2025. We can see that December 2025 was the worst December in history for home buyers putting houses under contract, which is a signal going into 2026 that we could have some weak buyer demand to start the year. Now, everyone's been trying to tell you that home buyer demand is going to rebound due to Fed rate cuts, due to the fact that the Trump administration is floating all these policies, but we're not seeing it so far. In fact, Redfin just came out with an article a couple days ago saying that buyer demand just dropped to the lowest level on record, according to their data on pending sales. Now, this isn't happening everywhere, everyone. And I want to be really clear about this. Like, in a neighborhood where I'm standing right now, it's unlikely we're going to see a big housing crash. The median income is above $150,000. The typical house here costs $1 million. You can see there's a house here I'm walking by right now that's just listed on the market for $1.65 million. Folks, you can let me know if you think this is worth $1.65 million. It sold for like $790 prior to the pandemic, and in a zip code like this, the inventory is still kind of low, and this is a really desirable area with wealthy homeowners, so no one's like in a rush to sell at a loss. So our forecast here in this neighborhood in Green Hills, south of Nashville, is basically flat year over year. However, if we zoom out, we can see other parts of Nashville, we have almost double-digit forecast declines in 2026. And I'm actually using this data on Reventure app to buy property. I'm in the process of negotiating a couple deals, everyone, and I'll tell you at the end of this video where I'm about to buy a couple investment properties for myself, especially potentially with some of the things that the Trump administration is doing right now, everyone, because they're really focusing on the housing market, and I think some of these policies could have a big impact, and the most notable is the Wall Street investor ban. I first reported on this a couple weeks ago to you guys that Trump said on True Social they were going to ban investors from the housing market. Some people were skeptical about it. Well, they just signed an executive order in the White House to make it happen. This executive order basically sets the wheels in motion on instituting an institutional investor ban. The Secretary of the Treasury, Scott Bessent, has 30 days to kind of define what an institutional investor is, and after he does that, they're going to produce legislation to go to Congress to codify it into law. So the executive order doesn't mean that the ban has started yet, but it means that it could happen soon in the future. And I actually know some people who deal with these Wall Street investors, everyone, and they're telling me that some of these investors, in fact, one big investor has already stopped buying because of this executive order. So even if it doesn't get to Congress in the next month or two, it seems like some of the Wall Street investors are already kind of stopping in their tracks, because if the president wants to make it illegal, these investors have to raise institutional capital to buy homes. Some of that capital might not want to invest in it if there's an executive order trying to ban it. I'm actually really curious about what that institutional cutoff is. It going to be someone who owns 1,000 homes, 100 homes, or maybe even 50 homes? What do you guys think that cutoff should be for institutional investor, and how do you think this should be enforced in the future? Do you think the government should hire people to kind of monitor how many homes investors own? One of the things in that executive order that was talking about was that in addition to potential congressional legislation, they're going to have the Federal Trade Commission and the Attorney General review large transactions by investors for anti-competitive practices. They're also going to look at potentially some price fixing, rental rate fixing if that's happening, and investors who keep vacancies high. So it's actually not just Congress, it's not just the executive order. FTC and Attorney General has now been directed to focus on these big landlords. And you guys might have seen in some of my shorts, like I just went on a trip in Texas, I stumbled upon several different communities with lots of rentals. One in particular in Houston, there was dozens and dozens of rentals that were being kept vacant. They weren't cutting the rent. Who knows? Maybe the Attorney General and the Federal Trade Commission might now be investigating those landlords. But on the existing market from existing sellers, the sales are still in the tank. According to the NAR, the sales dropped 9.3% month over month in December 2025, and the sales are down 30% from the pre-pandemic norm. I was looking at the mortgage application data through the third week of January, trying to see, is there any improvement happening? Like, if you're a realtor or mortgage broker, is there any hope for you kind of like with more macro demand in the market? The mortgage application index is now up to like a 193 for purchases of homes. That's up 16% year over year, but it's down 40% from where it was 3 or 4 years ago, down 30% from pre-pandemic norm. All of these metrics are showing everyone that demand is still in the basement, and it's not just seasonal. I know some people like to say, oh, December and January are usually slower sales months. Folks, this data is seasonally adjusted, meaning it adjusts for difference in seasonality, and we're comparing it against the same months in previous years. So even though December and January are slower months, the fact that the sales are the lowest on record for those months is telling you the demand is still really, really low. This is the big thing that a lot of people in the housing market are slowly starting to understand, that it's not really just about mortgage rates, it's about prices. And if you look at the last 130 years of the US housing market, we've just never really seen home prices this high compared to inflation. You can see the only other time it came close was 2006 and there was a crash. Now we're in another bubble. The inflation adjusted prices are 2 times the long run average, and that ultimately explains why the demand is so low. Another data point that supports this is the home price to GDP ratio in the US. If we take the aggregate value of the US housing market, which is 52 trillion, and divide it by GDP, our economic output, which is 31 trillion, we get 167% home value to GDP ratio in the US. You can see this is very historically high. Normally it's only around 120%. So home prices have gone up way faster than the overall growth of the economy, than worker wages. That's essentially what that's telling you. So we have multiple data points here showing you guys that prices are just too high. And I think a lot of you kind of feel that when you're going and looking at houses. I'm looking at houses around Nashville all the time, and I see some listings with price cuts, I see some sellers taking losses, but then I see other homes where they're trying to still double the price from 6 years ago. Or a house that maybe was worth 350 grand is priced now at 600 grand 4 or 5 years later, and that's just not workable. The monthly payments on these homes are over 4,000 a month in some cases, and the wages just haven't kept up. Look at this, the builder. We got 2 luxury houses under construction right next to each other. I wonder what the price tag on these puppies is going to be. I would not be surprised if the price tag on these is $3 to $4 million. Here, what they do in Nashville is they'll buy sometimes some of the the older homes, and they'll tear them down, like what they probably did here, and they'll buy the tear down for like $1 million. Like literally, they'll just buy it for the lot value of $1 million, existing house, tear it down, and then they'll build a luxury house in its place, price it at $3 to $4 million. Just a couple blocks from here, there's a luxury house on the market for 4.3, 4.4 million. The seller's actually losing money on it from what they bought it for a couple years ago. They're losing maybe 75 to 100 grand. I don't really know who's buying these $3 and $4 million homes. You guys can let me know if you see them in your city, in your metro area. But here in Nashville, there's lots of luxury houses. There's over 300 houses on the market, priced at more than $3 million going into 2026 in Nashville Metro. That's more than Atlanta, more than Dallas, and more than Austin. So Nashville, which is smaller than all those metro areas, has more $3 million homes than all those metro areas. I don't know how it makes sense. Maybe there's a lot of people in country music who are making a lot of money and they buy these puppies. And so what's really important is that if you are looking to buy a house this year, or investment property, you understand the data for your area. What's the forecast on Reventure app? Is it overvalued or undervalued? What's the long-term growth score? Those are the 3 key metrics I'm going to tell you a bit more about later that will help you understand if it's a good or bad time to buy. But now I'm going to reveal to you guys where I am actually looking to buy real estate right now. I'm actually in negotiations to buy some property, and I'm looking at Atlanta. I'm just going to let you guys know. I'm looking at Atlanta because Atlanta's a market where prices have come down quite a bit in certain pockets. Now, I talked a lot about it on this channel. You look at the home value growth map of Atlanta, a lot of areas down double digits over the last 12 months. Reventure forecast says certain areas are going to keep going down in 2026. That's good news if you're a buyer, and I'm going to take advantage of some of those declines in Atlanta in some zip codes that I think are actually kind of trending towards being more fairly valued. And I'm going to buy 1 or 2 properties there probably in the next 2 to 3 months. And I'm actually going to start building my investment portfolio. For many of you who might not know, I don't really actively own homes. I thought the market was very overvalued the last 4 or 5 years and didn't really have an interest in getting into it. But now that we're seeing prices drop enough in certain markets, I'm starting to make some offers. I'm starting to negotiate. And the properties I'm looking at right now in Atlanta are already kind of listed for below what people paid for them 2 or 3 years ago. And they're in areas where I think there's good long-term potential. So if you can get a property below market value, below what someone paid 3 years ago by a decent amount, maybe get closer to 2020 pricing in a zip code, in a neighborhood which has good long-term growth prospects, that's a winning combination in this market, which overall is still very overvalued. But we're seeing the pockets start to show up where you can buy property at discounts in good locations for the long term. Again, that's kind of my buy box. I want a downward forecast in the next 12 months so I can negotiate a good deal. I want fairly valued to undervalued on revenge traps over valuation rate, so I'm not going to get crushed after I buy. And then I want good long-term growth score, so it's going to be a good place in the next 10 years. And so the issue in the market now, which is destroying the market,
these AI option trades are better than anything I've ever tried before. What if you knew that
is the perception of home value by existing owners. It's not realtors, it's existing owners. Almost every time I talk to a realtor who deals with listings, they're frustrated that the existing owner isn't cutting the price more or isn't allowing them to list at a lower price. And the result is homeowner equity in the US is through the roof. Homeowners have about 36 trillion in equity, which is a record by far. And some people view that as good. However, it's not so good right now because that excessive homeowner equity, which is essentially the perceived value that owners have of their house, is disconnected from the reality of what the price and equity needs to be to make transactions happen. So it's this equity that's really high, and these owners, when they live in the house, can feel good about it, but it's actually not a price and an equity level they would be able to sell their house at in many cases. And as a result, there's no sales. Sales are at the lowest level of all time. Buyers feel priced out. Realtors and mortgage brokers don't make commissions, and sellers who want to sell their houses often don't end up selling their houses. It's really like everyone is losing in this scenario. And the only way to fix it is to have the prices go down. It's the only way to fix it. Existing owners need to give up some of their equity, just like builders gave up some of their equity. If existing owners were to cut the price 15 to 20%, you would see demand in the market surge. You would see demand come right back in. And the amazing thing is, if prices were cut 20%, homeowner equity would only drop from 36 to 28 trillion. There would still be so much homeowner equity. It would still be more than 2 times more than it was in 2006. So, this is the path forward, everyone. Lower prices. Builders are proving it. The fact that pending sales keep plummeting on the resale market is proving it. We need lower prices. We need more inventory. One idea that I think could help get more inventory is a capital gains tax holiday, where we get rid of capital gains tax for all long-term owners, those who've owned over 10 years. We get rid of capital gains tax for 2 or 3 years, include investors in that, because we want investors to sell. I think we'd see a deluge of supply. I think we'd see prices drop, and I think we'd see transactions surge if we had a capital gains tax holiday. Another idea Trump floated was to allow primary homeowners to claim depreciation on their house. He just said this at Davos a couple days ago. I think that would actually be a bad idea. I don't know how allowing a primary owner to claim depreciation would lead to more transactions. I think that actually could cause transactions to go down and would maybe artificially inflate prices. I don't think that accomplishes the goal of getting more Americans into houses. I think a better idea, if we wanted to change depreciation, a better idea would be to lower the amount of depreciation that investors can claim. Why do we allow investors to depreciate their houses on a 28-year depreciation cycle when commercial is 39 years? If you're buying a house to use it as an investment, depreciate it at 39 years, that would lower the amount in tax savings that investors could claim and would, I think, cause a lot of investors to sell, reduce their incentive to buy. You give a capital gains tax holiday, and then you lower the depreciation that investors can claim from 27 to 39 years. You solve all types of problems in the housing market overnight. You put listings back on the market, you reduce the investor incentive to buy, you put more houses in the hands of regular owners, you increase inventory, you lower prices. It's a win-win for everyone. Because the current tax structure on real estate makes no sense. Why do we incentivize people to hold real estate with the tax system by giving them tax breaks while penalizing them for selling real estate through aggressive capital gains tax? Doesn't make any sense. I think we gotta look there. If we honestly want to fix the system, push more homes to the market, make homes more affordable, allow more regular Americans to buy homes from Main Street, fix the tax code, don't give more tax breaks for owning real estate, give a tax break for selling real estate, and don't allow investors to claim as much depreciation, convert from a 27 to a 39-year cycle. Those 2 suggestions are winners. Trump administration should do that in 2026. It would go a long way in solving the housing crisis. Folks, if you're looking at buying a house or investment property in 2026, you need to be looking at the data for your market. As I discussed in this video, huge differences by city and zip code, by neighborhood. Here in Nashville, we have zip codes like I'm standing in right now, we're forecasting flat prices. We have other zip codes where we think prices are going to go down almost 10%, based on inventory, based on DOM, based on the price cuts, based on the supply-demand fundamentals. So you're going to need to know that data as well as the overvaluation rate and the long-term growth score for your